My next guest is watching all of these reports on the economy closely for signs of when the Federal Reserve might boost interest rates. Tom Sowanick is the co-president and chief investment officer of OmniVest Group. Tom, good to have you with us. Thanks for coming in.
Thank you.
You're pretty optimistic about what's going on in the market right now, right?
I'm very optimistic.
You're very optimistic. Yes. Why?
Because this administration and the previous administration really focused on trying to resuscitate financial assets and real assets, and we've spent plenty of money doing it, and they've succeeded.
And do you think that the stimulus package, which some people say hasn't really already kicked into gear, do you think that's going to be a big driver 2010?
I don't think it will be a big driver, but I think it will be a driver. The big driver is going to be the net effect of the wealth that's been created in 2009. And if we think about it in terms of the clawback from the equity market collapse of 2008 and the depression in housing, we think this year so far we've added $5 trillion of net worth to the consumer. And if we can add another 5% in the fourth quarter, then we would have added net $7 trillion to household net worth. That's a little bit bigger than $800 billion in stimulus.
Do I get to challenge you at all on it and say, aren't we just kind of back to where we were third, fourth quarter of 2008? I mean, you talk about this additional wealth, but if you take a look at, let's say, the chart, S&P 500, the Dow, we've really just added back what we lost during the last 12 months.
Assuming that you've done nothing over the entire time period, you're right. But let's assume that investors, whether they're retail or institutional, have the wherewithal when something looks horrible to get out.
All right.
Right? Let's just assume that for a moment. So we're not clawing back all of what we lost. We're clawing back some of what we lost. And if you had the wisdom to own Ford over this time period as opposed to Citigroup, you would have tripled your money as opposed to getting a third of your money.
Well done.
So there are ways of approaching it. The notion that the equity market over the last 10 years has done nothing and that bonds have outperformed stocks. It's true at face value, but if you say, you know what, I'm going to trade some a little bit, and had I been out of the market 2000, 2001, 2003, and got back into equities in 2004, guess what?
You would have done much better.
Well, you would have done twice as well as bonds.
All right, let's talk market timing aside. Tell me about the timing for corporate profits. You think corporate profits are going to really blow away estimates?
I think so. And if we look at the S&P, which currently is trading on a forward PE of 17, if we get earnings of $60 next year, which we think are likely, you're going to have, you could sustain this rally to. If we hold 17, we could get around 1,300. If we go back to 20, then you're looking at the S&P somewhere around 1,500. I'm not saying we're going to 1,500.
You can say it. It's all right. It's what would be close? 1,100, 14, 1,100, somewhere around there.
11, 14, and that's without any retail participation. I mean, if we again look at the mutual fund flows, net year to date, negative flows into equity funds. So I think that we have a lot of pent-up demand for equities. It's just that we're still a little bit fearful. When is the Fed going to raise rates? Does it really matter? Treasury yields have risen a lot this year.
I was going to say, what about that pent-up demand supposedly for treasuries? I mean, you've been writing about the implied sort of interest rate increase. Tell us about it.
Well, the Federal Reserve, Bloomberg has this wonderful analytical tool that allows you to look at the implied probability of the next Fed rate hike. Prior to the most recent FOMC meeting on December 16th, the probability was 43% that the Fed would raise rates at the June meeting. That has now fallen, over the course of a week, it's fallen to now it's only a 9% probability. So all of this noise about the Fed raising rates and how that's going to support the dollar, I think it's a lot of gobbledygook.
All right, so we can discount that. What about the U.S. dollar and its recent strength? Is that something that we should just get used to for a while now?
I think you probably get used to it till year end, and then if we get used to doing something else. The dollar index is up 5% from its most recent low. But what's happening is that very discreetly we're seeing the Canadian dollar gain strength, we're seeing the real gain strength, we're seeing the peso gain strength. Not just relative to the dollar, but relative to the Aussie dollar, the New Zealand dollar. So what I suspect is happening is that we're having some profit taking in some of the high flyers this year. and it makes sense coming to this point.
People take some profit off the table a little bit. What about what's going on in the world of commodities right now? Tell me about your thoughts on gold and all of the activity that we've seen in, let's say, the last 6 months in gold, over $1,000 an ounce.
Over 1,000 to 1,100, but it's not the precious metal that we should be paying attention to. If we look at palladium, platinum, silver, and gold, who's the worst performer? Gold. Right. You look at palladium, which is up about 100% for the year. Silver's clearly outperforming gold. Gold is interesting because a lot of people wear it. Right.
But you want something with an industrial use. You want something that's got some business connection.
Silver has more industrial use. Obviously, palladium does, platinum does as well.
Right, the catalytic converters.
But the story about gold is really about the dollar. It's not about the economy. These other commodities are about the economy, and not just ours globally. So I do believe that gold is heading much higher, and I do believe that the dollar, I'm not sure it's going to move a lot lower, but I think it's going to move lower, and I think we're going to test the old secular lows, which was, what, 71 on a dollar index basis.
What about equities? Stay invested in equities, look for equities, stock pickers market?
I think it's better than stock pickers market. I mean, I think you can make a lot of money just being in the broad market, but if you can get the stocks right, absolutely.
All right. I want to thank you very much, Tom Sowanick, coming in from OmniVest Group, co-president, chief investment officer. As always, appreciate it. Thanks.
Thank you.